In this month's Economic Update, Kaplan Professional Education's Trevor Treharne speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Trevor Treharne, and this month we're joined by AMP Capital's Chief Economist, Shane Oliver. Thanks for joining us today, Shane.
Thank you, my pleasure.
The Organisation for Economic Cooperation and Development has stated that Australia's economic growth will temporarily slow to 2.5% this year. Is this a major point of concern?
I think there's no doubt the Australian economy has slowed, and it's probably going to slow a little bit further. The OECD, I think, like is often the case with those big international organisations, takes a while to work that out. And the fact that they've just worked it out really just indicates that they're a bit behind the curve. I think other economists and myself have been a little bit more concerned about growth ahead of the OECD. But basically what's happened in Australia is that the mining boom is fading rapidly, and against that the rest of the economy has been slow to respond to lower interest rates. So consequently we're seeing a slowdown in growth to below trend, I think a bit more below trend than the Reserve Bank talks about. So we will be going through a rough patch over the next, say, 12 months. As we go into next year, I think growth will start to pick up in response to lower interest rates and the low Australian dollar, and the lower Australian dollar, I should say.
We've seen the Australian dollar dip in recent weeks. What have been the primary factors behind this fall?
I guess there's a few things driving the fall in the value of the Australian dollar. The first is, if you go over the last few weeks, the first thing was, of course, the Reserve Bank cutting interest rates, indicating it might do more. That was early May. Then, of course, we saw a sort of a mixed reaction to the budget. Then, of course, the economic news coming out of the US has been a bit better than expected. At the same time, in Australia, the economic news has been a little bit worse than expected. That in turn has led to more expectations of rate cuts in Australia at a time when America is talking about potentially starting to remove some of the stimulus the Federal Reserve is pumping in. And of course, finally, there's ongoing uncertainty about China and commodity prices. So all of those things, I think, have weighed on the Australian dollar, and the odds are it's probably headed lower, probably down as low as 80 cents over the next few years.
The contraction of the European economy continued last quarter. What will be the catalyst for the improvement in the troubled region?
Well, I guess when you look at Europe, the first thing to note is that it hasn't been in the headlines to the same degree it has been, particularly over the last 3 years. So that's a positive thing. There's less fear that the Eurozone is going to collapse and that countries will leave the Euro. That's a positive sign, so there's less financial risk around Europe. And that's seeing a gradual return to confidence, albeit from very low levels. My feeling is that this combination of still low interest rates in Europe, not quite as stimulatory as they are in the US, and a lessening of the financial risks and uncertainty around the euro hanging together, I think that'll see a gradual return to growth by the end of this year. But it's going to be a long, hard slog for Europe. They've chosen to take the slow path of gradually reforming their economies, and that, of course, takes a long time to pay off. By the same token, over the long term, they'll probably end up in far better shape.
Despite a slightly improving economic outlook, consumer confidence in the US is still faltering. Why is that?
Well, in terms of the US economy, what we've seen over the last few years is sort of continued growth, but it's very moderate. And we've still got a situation there where we're 4 years into an economic recovery from the worst recession since the 1930s, worst slump since the 1930s, and yet unemployment in the US is still hovering around 7.5%, which is quite a high number, and there's still lots of spare capacity. That in turn obviously has a flow on to consumer and business confidence, that businesses are feeling happier than they were at the time at the height of the GFC, but by the same token, they're still below longer-term norms. My feeling is that as the economic recovery continues and unemployment comes down, then you'll see confidence continue to head higher. But for the time being, it's hard to see the US economy breaking out of this sort of slower growth phase. We're talking about growth 2.5%, which is okay. They're coming out of it. It's also worth mentioning, though, that maybe we don't want excessively strong growth out of the US, because as soon as they get excessively strong growth, then that, of course, will mean the Federal Reserve raising interest rates and taking away the punch bowl. So maybe it's the best outcome for the world to see modest growth out of the US rather than a return to really strong growth.
It seems many have tempered their lofty expectations for how quickly and successfully China's economy will grow. What is the next decade likely to hold for China?
Well, I think the reality for China is that it's gone through a very, very strong phase. We got used to growth in China of around 10%. And of course, many people thought that after the slowdown in China between, say, 2010 into last year, that with growth bottoming out, it will quickly pick up again. We're looking at 8, 9, 10% sort of numbers. That hasn't happened, and it's become increasingly clear that China has various imbalances. Debt levels have gone up, particularly for local governments and for corporates. There's a big shadow banking sector which is unclear as to how secure that is or not. I suspect it's probably okay, but by the same token, the fact that these things aren't properly regulated and are sort of outside the banking sector ambit, that does create a bit of uncertainty. There's also the social issues. You've seen there's very strong growth on the eastern seaboard compared to the western provinces. And I think at the end of the day, the government said, well, the 10% plus growth was fine when it happened, but it's led to imbalances. We need to see more balanced, more sustainable growth, and therefore we're happy with growth maybe around 7.5%, could be as low as 7%. So I think we have to get used to slower growth coming out of China in the years ahead. And that, of course, for Australia is occurring when we're just completing all this work on mines. So you've got a new supply of commodities picking up at a time when demand coming out of China is slowing down, and that's why the trend in commodity prices is sort of rolled over and broadly heading down.
Brilliant. Thanks for joining us, Shane.
Okay, my pleasure. Thank you.
That brings us to the end of the July PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.